PDD is one of the most fascinating e-commerce players in China right now. While Alibaba and JD.com often dominate the headlines, PDD has been racking up growth that deserves attention. It's best known for its discount approach and gamified shopping model, and the big question is whether that momentum can continue in a challenging 2024. China's economy is showing signs of a slowdown, competition is intensifying, and regulatory pressures remain an ever-present wildcard. The most recent quarter, Q3 2024, showed revenue of over 14 billion, a 44% year-over-year increase. That's still impressive, though it's notably lower than the near 94% growth it once enjoyed. The company's revenue mainly comes from online marketing services and transaction services. Online marketing services grew about 24% to 6.9 billion. Transactions surged 72% to 7 billion, suggesting more users are shopping on the platform or that PDD is capturing more value per purchase. Profitability is also robust. Operating profit rose about 46% year over year, and net earnings reached 3.6 billion. Compared to other Chinese e-commerce giants, PDD's revenue and earnings growth remains strong, and some investors consider it undervalued given its results so far. Naturally, this level of success attracts competitors. Alibaba and JD.com have rolled out their own discount-driven strategies and gamified features similar to PDD. This is worrisome for PDD because it once stood out with its group buying deals and social game-like shopping experiences. Now, larger players are mimicking those features, leveling the playing field. Merchants also feel less of incentive to stay exclusive with PDD and are listed across multiple platforms. This widespread approach to selling undercuts any unique draw PDD once offered to both customers and merchants. Now, regulatory scrutiny adds another layer of complexity. China's government tends to clamp down once a tech company becomes too influential, as we saw with Alibaba in recent years. PDD has faced questions around quality control, merchant disputes, and tax reporting requirements. New regulations make operations more expensive, and PDD's 1.4 billion fee reduction program aimed at helping merchants could safeguard its user and merchant base, but also trim its margins. On top of that, the uncertain macro environment in China, like always, remains an issue. The idea that consumers turn to discounts in tough times has helped PDD in the past, but there is no guarantee that advantage will last indefinitely, especially if consumer sentiment deteriorates or the broader economy remains sluggish. Now, to offset dependence on China, PDD has expanded internationally through its overseas platform, Temu. You might have seen ads for it if you're in the US. It's been growing at a remarkable pace, reportedly reaching tens of millions of monthly downloads and hundreds of millions of monthly visits in 2024. Temu offers steep discounts, often 60 to 80% lower than other retailers, leveraging Chinese manufacturing to supply global shoppers with cheaper goods. However, challenges persist. Shipping and returns are very complicated, especially if consumers are used to free, easy returns. Certain countries, including Vietnam and Indonesia, have started placing restrictions on foreign e-commerce platforms as well. Building mainstream brand awareness outside of overseas China communities is another hurdle. Still, if Temu can become profitable, it could reduce PDD's reliance on China and provide a major growth channel for years to come. PDD's strength includes its low-cost approach and the social shopping experience it pioneered. By connecting consumers directly with the manufacturers, it cuts out the many middlemen, keeping prices lower. The gamified aspects, spin the wheel deals, group buy discounts, makes shopping feel interactive, which can boost user engagement and stickiness. The downside is that these features are no longer unique. Rival platforms have adopted similar tactics, leaving PDD under pressure to keep innovating. Another point to watch is logistics. JD.com has invested in its own extensive warehouse and delivery network, ensuring reliable shipping, whereas PDD relies mostly on third parties. This has allowed PDD to keep costs low, but it can limit its scalability and control over the delivery experience, right? If Temu continues to grow overseas, the question is whether PDD will invest in stronger logistics partnerships or develop more in-house capabilities to meet international standards and consumer expectations. Now, on the financial health side, PDD holds a large cash balance of around 43 to 44 billion. That's a considerable cushion, offering flexibility for future expansion, share buybacks, or other strategic investments. It trades at around 7 to 8 times forward earnings, depending on the estimates, which is relatively cheap for a company still posting significant revenue and profit growth. This low valuation could signal a bargain if PDD successfully navigates future challenges, Or it might suggest the market is pricing in risks like regulatory actions and slowing growth in China. Those risks are real. The Chinese government can pivot quickly on regulation at any single time. Competition, both domestic and global, remains fierce. The macro environment in China is uncertain, and global expansion is no sure bet since each market has its own rules and consumer habits. There's also talk in the US about revising import laws, which could strip Temu of part of its cost advantage. All of those factors must be weighed before committing to an investment in PDD. Despite the headwinds, the company is still delivering strong numbers. Its international push has shown early promise, and its massive war chest of cash is a significant plus. The discount model that built its success in China could translate well to other markets, provided PDD managed shipping and returns efficiently and remains on the right side of the regulators. If it can keep innovating, fend off copycats, and handle the complexities of a going global, it may become a more established global e-commerce player. Given this mix of positives and uncertainties, I consider PDD a buy. The stock's valuation is relatively low, its balance sheet is robust, and its growth strategy, both within China and overseas, has the potential to propel it ahead of rivals. Although there is no denying the risks from regulatory actions, slower economic conditions, and formidable competition, the company's combination of strong financials, scalable discounting strategies, and anyone considering this stock should be prepared for volatility, as Chinese tech can be unpredictable. Still, the long-term upside might be worth the bumps along the way, especially if PDD keeps leveraging its strength in delivering real value in global markets. By stepping in when sentiment is lukewarm, investors could capture substantial gains if the company executes well on its international ambitions and navigates the regulatory and competitive challenges at home. All in all, with a clear-eyed view of the risks, PDD's risk-reward profile leans towards opportunity, making it a buy in my book. That's it, guys. If you liked the video, please hit the like button and let me know in the comment sections if there's any particular companies you'd want me to look at. Take care.